Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on August 22nd, 2022. Reminder for those of you in the Options Income Blueprint program, we have live trading. It resumes again tomorrow at 11 o'clock Eastern. Today, in the update, I'm going to talk about the trades and results from last week and a core stock review of General Motors. So last week we had a quiet week. Liquidity is a little bit tough this time of August, and the idea, of course, is not to lose money first and then to make money second. So we're a little bit careful, but we had a nice return on our Novavax position. Novavax is a vaccine company. It is much more of a traditional vaccine. It's a low-cost vaccine. But the stock itself is quite speculative, and now that there'll be money coming in, Novavax itself is less speculative. But when they reduced their forecast for what they were going to be able to sell, the stock took a big hit, and it was time to get in because of the way it was trading. Plus, the company has a pretty good future going forward. So last week, though, we did have a bunch of income coming in from rolls, as we do every week. It's very important for those of you who are new or don't even have never had experience with the concept of rolling. It's you're buying a put back and you're selling another one. And while some people say, oh, I want a fresh trade, I want to do this, I want to do that, well, that's like a poker player saying you don't want to win. You just want a new set of cards. And that doesn't really make sense when you're generating cash for income. And so the rolls have really generated week after week now for several months significant amounts of income and cash off of the capital base that is supporting the positions. And we're going to continue to do it going forward. As you can see, we were just a smidge below the target of 0.5% a week. Given liquidity issues in August and so forth and so on, not an issue. We were way up the week before. And as you can see, if you take a look at the open position list on the website, there's a staggering, because of liquidity issues, of trying to generate cash. We have a bunch of positions expiring this week. We have another bunch expiring next week, and we'll be rolling them. And the idea is to keep that cash flow even and coming in, regardless of whether there are very good opportunities for us for fresh trades. And so there's the overall performance. The performance based on the rates of return were very good. 0.9% of rolls in particular is very good. I mean, when you think about it, that's almost 1%. That's 40 to 50% annualized rate of return. So we're pleased. I'm pleased, excuse me. I don't know if you are. And but we are building momentum going into the post-Labor Day. There'll be a burst of liquidity and so forth and so on. But the market is giving us clues about what we might want to do. It sold off a bit last week. It's selling off this morning. It will sell off this morning. And it's a tug of war between, oh, the economy is good, profits will be good, let's go trade. Oh, the economy is good, unemployment is low, the Fed's going to continue to raise rates aggressively. Oh, that hits bonds, let's get out of equity. So the tug of war is going to continue. And we need to focus on stock picking, and we need to focus on what I call the new frugal. I'm not bragging. It's just a term that I came up with in 2010 when we were designing Options Income Blueprint. I started using it actually a couple of years before doing institutional research for the publisher of Traders Reserve, Day Durham. We were at Phillips Publishing together, and we were doing proprietary surveys and selling them to Wall Street for institutional investors, and they were fascinated by the new frugal. It was something that had not been experienced necessarily in the United States. And the new frugal is, instead of four relatives getting together and saying, let's have a big party and some little gifts for the graduation of a high school of the niece or the nephew or the sister or the brother, let's go to the Coach store and spend some bucks on a $300 beautiful black leather backpack. That's the new frugal. The new frugal is, oh, you know, the little polo shirt I'm buying at Macy's that's $69.99 from Tommy Hilfiger rather than $99.99 from Polo. I can go to Target. The mesh is the same. I don't have the little logo. Even if it wears out a little bit, it's $19.99. Maybe I'll get two of them, and so forth and so on. And if you think through product lines and you think through the way retailers market, it's an enormous universe for us to trade, not just in the coming weeks, but the coming quarters. And to the point of the new frugal, a company that you might think, wait a minute, what are you talking about? This is a car. It's $40,000. Or if it's a Silverado pickup truck fully loaded, it's $85,000. But it's part of a mindset of consumers taking a look at reducing gasoline costs and getting subsidies for their cars. It's I discovered when we were doing that primary research for institutions many years ago, people need to go to work. So even when they're hurting, cars are important. They come before even utility bills until the utility threatens to cut off your electric supply or water, what have you. Got to get grandma to the doctor and so forth and so on. General Motors is on track to be the electric vehicle leader by 2023. It has a very innovative battery strategy that they unveiled at a technical briefing at the General Motors Technical Center in Warren, Michigan. And it's a new foundation built on something called the Ultium, which is a 19-product foundation, meaning 19 flavors of an Ultium battery technology for the next generation or two or three of product lines. And I'll get into it a little bit more in a second. And frankly, I get questions literally every week. Why GM and not Tesla? Well, Mary Barra, who is, you see the last line here, I think one of the best. Now that her and Tim Cook, I think, are both tied for first as the best CEOs in the United States, totally different companies. Tesla is a radically overvalued stock based on traditional metrics for the auto industry. And someday it's going to come to earth. And it could come to earth because Elon Musk tweets something or whatever. GM is a totally different kettle of fish. It has nothing to do with headlines and Twitter. It's just produces cars. And it produces, if you're of a certain age, you remember when they weren't very good. If you're not of a certain age, there used to be times when you didn't want to go near a General Motors car, and now they're very, very, very good. Toyota passed it last year, but from a margin point of view, on a unit basis, meaning the profit margin per unit, it's hard to tell because of the way the German companies do their accounting, but they're certainly more profitable than on a unit basis than Japanese companies, and maybe more profitable than the German companies. Revenue was up despite supply chain issues, and margin and profits have finally come to roost as Wall Street's way of evaluating the company. It used to be gross sales and unit sales, and not anymore. Very solid balance sheet, especially compared to Ford. GM went through a bankruptcy during the crash in '08, cleared the decks of some pension obligations, so it actually has a stronger balance sheet than Ford. And I think that comes into play for some very traditional analysts making recommendations. And again, terrific management. Let's talk about EVs. It's committed and is on track to spend $35 billion through 2025 on electric and autonomous vehicles. Forget the autonomous, it's the electric that really matters. Autonomous is a relative term now. People begin to realize we're not going to have cars driving around without drivers next year. And Apple CarPlay is emerging as the de facto standard within the auto industry. It's a software standard. They expect to have an all-electric lineup by around 2035. The recent legislation is especially important for General Motors. Previously, federal subsidies were available only for the first 200,000 units that you sold, which Tesla and GM had done. That's been lifted. Now there's an income qualification thing for the tax credit, but it's big. It's $7,500. It'll significantly reduce the cost of the lower end and middle end of any electrical vehicle lineup. And I want to get back to the ultimate battery system. The success of EVs is based on the success of your battery technology. It's what Tesla has always done better than anybody as a car company. In fact, if I were on the Tesla board, I would say, forget making cars, go sell the car operation to somebody, let's just make batteries. And General Motors has partnered with LG, the Korean company, and they have created a new battery technology that significantly reduces their exposure to the need for cobalt. Cobalt comes from Central African countries, very unstable, supply chain issues you can imagine. There's war, there's a whole bunch of things going on. And they have a goal to less than 100 kilowatts per hour. They are focusing on what they need to focus on, which is a foundational technology and a foundational product, a battery platform, which can then be scaled. Smaller battery, smaller car, bigger battery, Silverado pickup truck. It's great. And I'm assuming they're going to be able to pull it off. They have joint ventures, and their production is outside of China, which is really important. If you read the fine print, on the Inflation Reduction Act. A lot of the automakers squawked because they're not going to be able to sell electric vehicles with batteries made to a U.S. friendly, made in a U.S. friendly country or in the U.S. So a very, very sound strategy. And so this is where I'm suggesting that you take a look at this as a long-term investment, even if you're not buying the stock and you're just selling puts. Think of it very long-term, but you can also take a look at it short-term because there are enormous premiums and you can trade it for income every week, which is what we do. From a valuation point of view, very, very, very low valuation. Even the auto sector always trades below the S&P 500 because of supply chain issues, that the gap was wider, but GM's gap with the rest of the auto sector was kind of wide. Nice stock buyback program, not a big deal, but it's an evidence that they believe their cash flow is going to be strong, which is the same for the reinstatement of the quarterly dividend. And I know Tesla's a speculative cult stock. It's not a speculative company, but it's a speculative stock, and you can see it's valued at 10 times more than General Motors, which of course does not make any financial sense. Now, short-term catalysts are the Inflation Reduction Act, strange name, and persistently high gasoline prices. They're not going to fall radically from where we're at. I just got off the road. I paid $3.59, I think, in Ohio, and people need their cars. There's pent-up demand for travel. People are going back to work. There'll be less gasoline used, obviously, for commuting. And the short-term catalyst is also people buying these cars knowing that the government's going to spend many billions building charging or subsidizing the building of charging stations. So there's a lot going on that's a short-term catalyst for the company and therefore, to my mind, the stock. And to that point, the stock has been breaking out. And it went up to the 60 or 62 or whatever it was with the whole EV thing when Build Back Better was first proposed. It then came back down to earth and is now trading on fundamentals, which is really, really, really important. So it is a longer-term catalyst, in my opinion. It'll be the largest EV company by 2024. I believe it's a superior compromising battery strategy, meaning there are people working on a pure play in nickel, which would radically reduce the cost of batteries and also significantly increase performance, but we're not there yet. We're not close to being there yet, especially with manufacturing issues. There's a superior focus on margins that actually Mary Barra started more than a decade ago, and it took a while for Wall Street to catch up. Oh, they want to make a profit. They just don't want to sell cars. And there's now a feverish anticipation of a nationwide build-out of an electric vehicle infrastructure, which is very, very important. Now, trading for General Motors. When you looked at General Motors at $39.70 late in the day on Friday, if you sold the $40 strike and you own the shares, you have a potential 2.7% return in 1 week if you're called out. If you sold the $39.50 put, you have an almost 2% return in 1 week if the option expires worthless. These are gigantic premiums. And when we're shooting for 0.5% a week, you obviously could have sold the 41 or the 42 call in case the stock broke 40 and ran. And you could obviously sell the 37.50 or the 38 put in case the stock traded down. So with those kind of premiums, it's the ideal income and cash generation stock in addition to longer term, if you put your investment hat on, radically undervalued. So speaking of trading for income, we have light volume this week. It'll get lighter the following week. The short-term bullish move may be running out of steam because that tug of war I said between, oh, the economy is good, profits will be up, oh, the economy is good, the Fed's going to raise rates more aggressively. And we're going to focus in part, not completely, on consumers and the new frugal. And it makes itself manifest in many ways. There are no major market catalysts in the coming weeks. We'll be back to live trading tomorrow. And you're going to see new positions that are post-Labor Day. Well, not post-Labor Day, post-September 1st, excuse me. And one anecdote as I sign off, the whole notion of the new frugal and consumers. I was on a road trip and staying overnight, I guess a medium suburb of Toledo, Ohio called Maumee, M-A-U-M-E-E. And at the Hampton Inn, there was a group of people in the morning on Sunday very upset because there's terrible weather. And they were a B-24, B-29, two bombers from the Second World War, and I guess the Korean War. And they were part of a club that would go up in the planes and experience them. And this is something they've been looking forward to. And so, of course, nosy me, I spoke to them. And it was something that's going to be regular, they're going to be doing, but the pandemic had shut this all down. Well, this was spending on hotels, spending on gasoline, spending at Dairy Queen, spending at the restaurants. And they weren't concerned about being shut in again going forward. So consumer is not just going to Target and buying a polo shirt. Consumer is overall spending. So please keep your eye out when alerts come out. It could be airlines, it could be hotels, it could be polo shirts, it could be General Motors. But the new frugal is a way to go for us, and it'll be used for a wide swath of our trades going forward. This is Michael Schulman. Thanks for listening.